Let's stop dancing around it like it's a Saturday night disco and talk about where this market is actually heading. Welcome back to Richard and Chloe A.I. Investing. The Federal Reserve has cut rates 3 times this year and quietly restarted liquidity through Treasury purchases. That's not a sign of strength, it's a sign of transition. Growth is slowing, but it's not collapsing. And markets don't wait for comfort. They move during transition. Here's what that means in real terms. Money is rotating. It's rotating out of what already had its moment and into areas that were crushed by high rates. Let's name names. Apple, ticker. AAPL is a perfect example of where money is rotating out of. Not because it's a bad company, it's a great one, but everyone already owns it. When a stock becomes that crowded, new money doesn't chase it first. It stalls while capital looks for better risk-reward elsewhere. That's rotation. Now look at small caps. Ticker IWM. These are smaller U.S. companies that took the biggest hit when interest rates went up. As rates come down, borrowing gets cheaper and earnings expectations improve. Money moves here before the economy looks good on paper. That's rotation in. Look at industrials. Ticker XLI. These are companies that build things, move things, and keep the economy running. When investors believe the economy will slow but survive, industrials quietly start working again. That's rotation in. Look at growth. Ticker QQQ. When rates were rising, growth stocks got punished. When rates fall, investors are willing to pay more for future earnings again. Same companies, different environment. That's rotation in. And look at real estate. Ticker XLRE. Not office buildings, warehouses, data centers, and infrastructure-linked property. High rates crushed this space. Falling rates change the math fast. That's rotation in. Now here's where people mess this up. They wait. They sit in cash because it feels safe. They cling to last cycle's winners because they feel familiar. They wait for headlines to tell them it's okay. By the time it feels okay, the move already happened. This market is not heading toward a crash. It's heading toward separation. Prepared portfolios will work. Outdated portfolios will quietly fall behind. If you haven't looked at your portfolio in the last 90 days, really looked at it, you're guessing. If you don't know which parts of your portfolio benefit from falling rates, you're exposed. You don't need to be aggressive. You do need to be intentional, because this is the phase where money gets repositioned quietly before the crowd catches on. This is Richard and Chloe A.I. Investing. If this helped you think differently about your portfolio, subscribe, like, and share it with someone who needs to hear it. Stay ready, because the market rewards those who move first.